If you have been studying economics, mentioning the dollar's potential collapse stirs curiosity and concern. There is a possibility that global finance will undergo a seismic shift. Under such conditions, one aspect that demands attention is personal and systemic debt. It can have a significant impact on your financial well-being. If you want to know how to face such a situation, then I can explain this in easy words. Understanding the dollar's significance. The value of the United States dollar, USD, is deeply rooted in its historical journey and the intricate global financial system it has come to dominate. The Coinage Act of 1792, which made the US dollar the country's legal tender and specified how it related to gold and silver, laid the groundwork for the USD. In the early years of the currency, confidence and stability were fostered by this linkage of value to material possessions. Early in the 20th century, the gold standard gave way to fiat money, a system in which the value of the dollar is not directly backed by actual goods. The Bretton Woods Agreement of 1944 formalized the USD's role as the global reserve currency, tethering other currencies to its value. In order to comprehend the worth of the dollar, we look to statistics like the Consumer Price Index, CPI. $1 had the same amount of purchasing power as around $26.80 does now in 2013. This illustrates the progressive loss of value brought on by inflation. Inflation causes a progressive loss of buying power, which is determined by factors such as money supply increase and economic stability. The relative worth of dollars declines when more are placed into circulation. Because the dollar is the world's major reserve currency, it has enormous power. Commodities such as oil are frequently exchanged in USD, strengthening its worldwide status and sustaining demand. The economic factors leading to dollar collapse. In the context of the potential collapse of the US dollar, an array of intricate economic factors could profoundly impact debt dynamics, triggering a ripple effect through global financial systems. To understand the potential repercussions of debt, we must dissect historical precedents, scrutinize present trends, and evaluate how various interconnected elements could converge. Trade imbalances and debt burden. The United States' persistent trade imbalances, marked by a consistent import surplus, contribute to the accumulation of foreign debt. If the dollar's value plummets due to economic turbulence, the burden of servicing this debt escalates. This scenario resonates with the Latin American debt crisis of the 1980s, where abrupt devaluations compounded debt burdens, straining economies and sparking defaults. Dollar depreciation amplifying debt. Intense monetary expansion can lead to inflation, causing the dollar's value to erode. A weaker dollar, while potentially boosting exports, renders existing debt denominated in dollars more burdensome. Consider the effects of hyperinflation on debt in Zimbabwe, where the local currency's collapse necessitated astronomical amounts of currency for repayment. Reserve currency shifts impacting debt. If major economies diversify their reserves away from the dollar, it could trigger a cascade effect on debt dynamics. China's gradual transition towards increasing its holdings of non-dollar assets exemplifies how shifts in global reserves can influence the dollar's value and subsequently impact debt obligations. Interest rate surges and debt servicing costs. Rapid increases in interest rates, though attractive to foreign investors, can escalate the cost of servicing existing debt. This phenomenon was evident during the 1997 Asian financial crisis, when surging interest rates caused economic upheaval and amplified the challenge of debt repayment. Digital currencies and debt restructuring. The rise of digital currencies, both cryptocurrencies and central bank digital currencies, poses the potential to alter debt dynamics. A shift towards alternative currencies could lead to debt restructuring and renegotiation as currencies' values transform. In light of the potential risks outlined here, individuals and entities can consider several actionable steps to navigate the uncertain economic landscape. Diversification of investments and assets beyond dollar-denominated holdings can mitigate exposure to currency depreciation and debt vulnerabilities. This could involve investing in a mix of foreign currencies, precious metals, and other stable assets. Impact on global financial markets. The potential collapse of the US dollar holds significant implications for global financial markets. Imagine a scenario where the dollar, a key reserve currency, experiences a sharp decline in value. This could set off a chain reaction, impacting various aspects of the global economy. Firstly, the value of different currencies might become highly volatile. Exchange rates could swing dramatically, affecting international trade and investments. The stock markets, closely tied to currency values, might experience fluctuations as investors seek safe haven assets. Oil, often traded in dollars, might see price increases due to the weaker dollar's effect on global markets. This could have a widespread impact on energy costs. Emerging economies with substantial dollar-denominated debt could be vulnerable. If the dollar collapses, servicing this debt could become more expensive, potentially leading to financial instability. Investors tend to turn to safe haven assets like gold during times of uncertainty. A dollar collapse could result in heightened demand for such assets, affecting their prices. Furthermore, the stability of global trade and capital flows could be disrupted. Individuals can adopt several prudent measures to safeguard their financial interests. Firstly, diversifying investment portfolios across various asset classes, including foreign currencies, precious metals like gold, and stable international markets, can help mitigate the impact of currency fluctuation and market volatility. Secondly, considering the implications of a weaker dollar on energy costs, exploring energy-efficient practices and alternative energy investments could mitigate potential spikes in expenses. Devaluation of currency and debt effects. A possible depreciation of the US dollar might have a wide range of negative effects, especially regarding debt dynamics. It's crucial to comprehend how a sharp decline in the dollar's value can affect different aspects of the financial landscape. A devalued dollar would immediately affect the purchasing power of consumers and businesses. The cost of repaying loans might rise for individuals with debt, particularly those with variable interest rates. This scenario is akin to inflation, where the value of money erodes over time, influencing the real burden of debt repayment. Governments and corporations with substantial dollar-denominated debt could face challenges. The cost of servicing this debt could escalate as the dollar's value diminishes. This situation can create financial strain, potentially leading to debt refinancing or defaulting. Bondholders could face losses if interest rates rise in response to devaluation. While a controlled devaluation can stimulate exports and economic growth, an abrupt and severe devaluation could lead to uncertainty and market volatility. This could prompt investors to seek safer assets, causing fluctuation in financial markets. The historical example of hyperinflation in Germany during the early 1920s is a cautionary story. Regarding this, individuals can take strategic actions to mitigate the negative effects on their financial well-being. Firstly, reassessing and potentially refinancing variable interest loans into fixed-rate options could help stabilize debt obligations in the face of rising repayment costs. Prioritizing debt reduction and exploring avenues for consolidating high-interest debts can provide a buffer against increased financial strain. Diversifying investments into assets that tend to perform well during inflationary periods, such as precious metals and real estate, can hedge against the eroding purchasing power of a devalued currency. Restructuring of debt and international agreements. When the dollar collapses, the repercussions will extend to the complex realms of debt restructuring and international agreements. Understanding how these aspects could evolve under such circumstances is crucial for comprehending the potential outcomes. Debt restructuring. A devalued dollar might prompt individuals, businesses, and governments to explore debt restructuring. Debt restructuring involves renegotiating terms to manage the changing dynamics. For example, adjustable rate mortgages could become more challenging as interest rates adjust based on market conditions. This situation could lead to individuals seeking refinancing options to manage increased debt burdens. Impact on international trade agreements. Trade agreements often involve currencies and their relative values. A dollar collapse might necessitate renegotiations of existing trade pacts. Countries can reconsider their economic ties and trade dynamics, potentially leading to new agreements and realignments. Private sector debt and corporate strategies. The private sector, including corporations and financial institutions, could face unique challenges. Debt issued in dollars might require adjustments to manage repayment obligations. Companies might explore alternative financing options and investment strategies. Rise in inflation and cost of living. If the US dollar were to face a significant collapse, one of the immediate and pronounced effects would likely be a rise in inflation and an increase in the cost of living for individuals and households. This dual impact can potentially reshape the economic landscape in various ways. A devalued dollar can trigger inflation as the purchasing power of money declines. This inflationary pressure could stem from various sources, including increased import costs due to the weakened dollar, impacting the prices of goods brought into the country. The cost of everyday essentials, from groceries to fuel, could surge. Imported goods would become more expensive due to the weaker dollar, causing a direct increase in their prices. This could strain household budgets, especially for those on fixed incomes. In response to rising prices, consumer behavior might change. People might cut back on discretionary spending and prioritize essential items. Engaging in community initiatives such as local food co-ops or community gardens can help supplement the cost of groceries and provide access to fresh produce at lower prices. Embracing sustainable practices like reducing energy consumption, using public transportation, or carpooling can help mitigate the impact of rising fuel costs. Additionally, enhancing financial literacy and learning practical skills such as budgeting, cooking, and repair can empower individuals to make frugal and resourceful choices, stretching their dollars further. Global trade disruptions and supply chain challenges. The potential collapse of the US dollar could reverberate through trade networks and supply chains, introducing a complex interplay that directly influences debt dynamics. This cascade of effects emerges from the intertwined relationships between nations, corporations, and financial systems. A devalued US dollar would immediately disrupt trade balances and international commerce. Imported goods would become more expensive for Americans due to the diminished dollar purchasing power. This shift could reduce demand for foreign products, affecting countries dependent on exporting to the US. For instance, if a country heavily relies on exporting goods to the US, a certain decrease in demand could harm its economy and its ability to manage its debt. In a stark revelation, UN Secretary General Antonio Guterres has spotlighted a concerning reality. Half of humanity is grappling with a disheartening dilemma. Nations find themselves allocating more resources to service their debt than to essential sectors like health and education. This distressing scenario underscores a development catastrophe that lurks beneath the surface of global economics. To address the potential global trade disruptions and supply chain challenges stemming from a US dollar collapse, international collaboration and innovative policies are essential. Nations should work together to diversify their trade partners and reduce dependency on a single market, fostering resilience in their economies. Developing regional trade networks and investing in domestic production capabilities can help mitigate the impact of reduced demand for exports. Overall, a potential collapse of the US dollar would set off a chain reaction through global trade networks and supply chains, posing challenges and opportunities for countries, businesses, and the financial system. Navigating this intricate landscape would require adaptability, strategic planning, and a keen understanding of the factors at play. Understanding these complexities is crucial. If you found this video valuable, don't hesitate to hit the like button and share this video with others. For more thought-provoking discussions, you can watch the next video on my channel and also hit the subscribe button.